Imagine this is a call option and this is a put option, and one of them is flying while the other one sits there idle. That's your straddle in motion. Welcome back to another episode of Stockshaala by Kotak Securities. I am Pranav VK, an NISM-certified trader and trainer, and your friendly navigator here through the ups and downs of options trading. If you can recall, a straddle works beautifully well when the markets are calm. But when it starts moving fast, then as a straddle strategist, you also have to move faster and smarter. Today, let's learn how to adjust a straddle if the market starts moving in a single direction. So let's start with the base setup of 19,500 straddle, wherein you have sold call option as well as put option, and the payoff diagram looks something like this. And assume that we have got 200 rupees premium on either side, which means overall we have got a net credit of 200 plus 200, that is 400 rupees. Now when Nifty is in and around 19,500, it is all good and peaceful. But what if it starts moving towards 19,750? The put options will give you small profits, whereas the call options would have started making some huge losses. And that is the time to adjust. Now when the market has shifted from 19,500 to 19,750, now is the time to adjust the profitable side. So since the put option side is untested, it is wise to book the profits on 19,500 and shift it to 19,600. Now you're going to have a small strangle, but you have enough time to adjust and rebalance. The resulting effect is that the delta imbalance is reduced. Here is an important tip while making this adjustment. Always make sure that you're booking the profitable side and shifting the same, not the losing side. Now the second adjustment that you can do is convert your straddle into a ratio spread. So let's say, for example, the market starts moving in the positive direction and you have to make sure that you protect this side. So that is when you can go for a put ratio spread. Whereas if the market is falling continuously and you want to protect the downside, that is when you can go for a call ratio spread. So a call ratio spread looks something like this, whereas a put ratio spread looks something like this. So this way, if it's going continuously on the positive side, you can see that the put ratio spread is in profits on the upside, so you're protected, and similarly on the downside as well. The next adjustment that you can do is adding a directional bias. And if you see that the market is trending in a single direction strongly, then that is when you can add an additional hedge. For example, you have the straddle and you see that the market is going up continuously. That is when you can go for buying a Nifty future or even adding a call option, which is going to reduce your overnight risk. Use this when the momentum is clear and you expect a continuation in momentum. So let's take a practical example and understand this step by step. So let's take the same example for easier understanding. So initial setup, we have 19,500 call option as well as put option. And let's say at this point, we have a net credit of rupees 400. Now when the market starts moving from 19,500 to 19,750, that is when we have to make an adjustment. Now we know that we should always book profits and not exit on the losing side. So what are we going to do? We are going to exit the 19,500 put option. So this is profit booking. So this is the first step. The second step is we are also going to enter 19,600 put option and we are receiving fresh credit. And finally, if we see that the market is moving even further, that is when we can go for converting this into a ratio spread by buying 19,800 call option and selling 20,000 call option. So this will become a ratio hedge. The outcome of doing these proactive steps is that number one, your delta is going to be rebalanced. Number two, you have limited upside loss. And finally, number three, you're still earning from time decay, that is theta. Here are a few key principles that you have to remember when doing adjustments in straddles. The first one is that don't over adjust. Always make sure that an adjustment is backed by logic. Number two, always track your total credit after making the changes. If your loss is greater than 1.5 times of the credit that you have received, then it's time to exit and not adjust. Watch for implied volatility as well as price action before you make any adjustments. And remember to always check option chain OI shifts so that you know where the writers are moving and you can too. Straddles are like balancing on a rope. It looks easy until the wind changes direction. With these adjustments, you will stay balanced even if the market swings. You're watching Stockshaala by Kotak Securities. I am Pranav VK, an NISM-certified trader and trainer, and I'm going to see you in the next video where we are going to cover about adjusting strangles.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.